On 31st January 2024, the RBI imposed a massive penalty on Paytm. It stopped the company from doing any transactions on its payments app, and suddenly millions of customers and merchants on Paytm did not have a bank. It was a big setback. The payments bank was at the heart of Paytm's operations. The next day when the stock market opened, Paytm stock was down 20%. The day after that, another 20%, and then another 10%. In just 3 days, Paytm had lost more than half of its value on the stock market. And many experts predicted that it's impossible for the company to make a comeback. This was a big challenge for Vijay Shekhar Sharma and his team, the company that they had built over the last 10 years, the company that made wallets popular and in a way birthed mobile payments in India, was struggling to survive. But over the next few months and quarters, VSS and his team took some bold and long-term decisions that not only saved the company but also made it a sustainable, profitable business. In the most recent quarter, Paytm posted a net profit of 123 crore rupees, its first ever profitable quarter after the IPO. And this is a big deal. In the same quarter last year, the company had posted a loss of 839 crore rupees. And this turnaround is what I want to talk about in this video. How did Paytm do it? And why did the RBI penalize the company in the first place? Let's understand in this video. And before we start, I want to say that we are now part of the 01 network. So, Paytm was started in 2010, around the time when smartphones were just getting popular in India. And Vijay Shekhar Sharma was inspired by Alibaba's Jack Ma and especially by his company Alipay, which had made mobile payments big in China. And VSS wanted to do the same with Paytm in India. In fact, the term Paytm stands for Pay Through Mobile. In the early days, Paytm allowed people to do things like mobile recharges and bill payments. It was only in 2014 when the company launched its Paytm wallet that mobile payments became mainstream in India. Paytm's first major win was in 2015 when Alibaba invested around $680 million in the company for a 40% stake. And this was huge. The person who had inspired Vijay Shekhar Sharma to start Paytm had put so much money into the company. And Paytm used this money wisely. It expanded to new categories like e-commerce, movie and event ticketing, and most importantly for offline merchant acquisition. The company hired thousands of training staff to educate and acquire millions of merchants across India. And what these people did was they deployed Paytm's QR codes at these shops and opened bank accounts for these merchants at Paytm Payments Bank. This was a great strategy. Paytm was doing a one-time investment to acquire these merchants. It was giving them free QR codes and these sound boxes that you see around. And the idea was to charge them a small subscription fee per month from these merchants. And very soon, Paytm was involved in a lot of things. Firstly, it had various payment services like wallet, UPI, merchant payments, various bill payments, and FASTag. Then there were various financial services like payments bank, lending, wealth management tools like mutual funds. And finally, there were various e-commerce services like Paytm Mall, movie and event ticketing, games and advertising services. And the problem here was that there was no single focus for the company. Its idea was to enter into as many segments as possible and then burn money to acquire users. And although this was helping the company in its revenue growth, its losses were also piling up. Take a look at Paytm's financials. Its revenue increased from 336 crore rupees in FY 2015 to 3,350 crore rupees in FY 2019, a 10x growth in just 4 years. But its losses were going up as well, going up from 372 crore rupees to almost 3,000 crore rupees in the same period. Now, by the year 2020, it was clear for Paytm that they have to do an IPO soon, and that's why their losses started reducing. In FY 21, the year Paytm went public, their losses went down by almost 42%, and it looked like that the company would soon get profitable. But this was when the trouble started brewing for the company. So, the root of most problems at Paytm is their Paytm Payments Bank Limited, which is an associated entity of their main company. This payment bank was started in 2017. And for people who don't know what a payments bank is, it was a new initiative by RBI in 2014, where the idea was to take financial inclusion to every person. Now, we did have banks, but the thing is, opening and running a bank is a very regulatory heavy process. There are numerous licenses you need in order to run a bank in India. And the payments bank is sort of a lighter version of a full-fledged bank. Here you can allow people to deposit money, get a debit card, and even transfer money domestically. Just the basic stuff. You couldn't give loans or issue a credit card with this payments bank license. Now, Paytm launched its own payments bank in November 2017, and the cracks started appearing right from the beginning. In just 6 months of getting the license, Paytm got a warning from the RBI, and it asked the company to stop opening new accounts. The issue was non-compliance with KYC norms that RBI found during an audit. In simple words, Paytm was not following the due process of opening bank accounts. In some cases, the company had not done proper identification to open new accounts, and in other cases, it used a single PAN number to open hundreds and even thousands of new wallet accounts. Also, Paytm's tech and cybersecurity infra was not robust enough, and the RBI feared data leakage of customers. This ban of not opening new bank accounts was lifted 6 months later in January 2019, but these things kept on repeating. In October 2021, RBI imposed a 1 crore rupees penalty on Paytm for the same issue. Then, just a few months later in March 2022, RBI again imposed a fresh ban on Paytm on onboarding new customers. Now, KYC related issues were still there, but the RBI now found some even serious problems with Paytm. The first one was the governance structure of Paytm Payments Bank. See, 51% of this bank was owned by Vijay Shekhar Sharma himself, and as 49% was owned by Paytm's parent company 197 Communications. And according to the RBI, the bank's governance was highly influenced by Paytm and its CEO. See, RBI says that if a payments bank is a part of a bigger group, for example in this case Paytm, then this bank's governance and day-to-day operations should be independent of the main group. It should function as a separate entity. But in the case of Paytm, RBI found that the day-to-day decisions of the payments bank were being taken by Vijay Shekhar Sharma and his parent company 197 Communications. So this was the second big issue for RBI. Then there was a third issue where Paytm's payments bank was found to be indirectly giving out loans. And this was a clear violation of the RBI's guidelines that a payment bank can't issue loans to its customers. And by now these issues were getting too much. And despite many warnings, Paytm did not do much about it. Then finally in March 2024, RBI took the big decision. Under Section 35A of the Banking Regulation Act, it barred the Paytm Payments Bank from accepting new cash deposits and loading money into wallet and other services like FASTag. It also stopped the company from providing other banking services like AEPS, IMPS, bill payments, and UPI transactions directly linked to PPBL accounts. RBI Governor Shaktikant Das publicly stated that regulated entities are given sufficient time to take corrective actions, but effective action is taken when compliance failures persist. For Paytm, this was a disastrous decision. In a way, RBI forced the company to stop almost all of its banking operations, which were at the heart of company's different products. And now the company had to partner with other banks just so that Paytm's customers could continue to use services like UPI, wallets, and FASTag. This was a massive blow, and it was widely described as an existential crisis for the company. And this was reflected in the company's share price too. Paytm's stock price was 761 rupees on 31st Jan 2024, and this dropped by more than 55% over the next 2 weeks, reaching 341 rupees on February 16th. Basically, the company lost more than half of its value in just 2 weeks, which was crazy. But after this, the company and its founder Vijay Shekhar Sharma took some bold and long-term decisions to turn things around for the company. Now, after this RBI's announcement, Paytm had a dual challenge. Firstly, it had to retain its customers and merchants from leaving the platform. And then the company had to work on its financials to give confidence to the investors on the stock market. So, to retain its customers, Paytm acted swiftly. Almost immediately, it reached out to National Payments Corporation of India and applied for a third-party application provider for UPI services. And they got this approval within weeks. This ensured that the existing customers of Paytm could continue to use its UPI services. It's just that the company had to partner with third-party banks for it. Also, Paytm changed partners for other services like wallets and FASTag, and this ensured that Paytm users can continue to use these services on the platform. It's just that their bank had changed. And finally, Paytm did the same for its merchants as well. There were millions of merchants who had settlement account with Paytm Payments Bank, and the company swiftly transitioned them to a new bank account. And this ensured that the merchants could continue to accept payments via Paytm's QR codes, sound boxes, and card machines without disruption to their daily business. Now, this was a short-term thing that the Paytm did. The main challenge for the company was to improve its finances. And frankly, this RBI decision gave a perfect opportunity to Paytm to sit back and refocus on its core business. the company realized that its core business is payments and financial services to the merchants, and that's what it started focusing on. Almost immediately, Paytm started selling its known core products, for example, Paytm Insider, which they sold to Zomato. Then there was the Paytm Mall, which the company has scaled back significantly. And also, Paytm paused its postpaid service where it allowed various BNPL features. And now all the focus was on its payments and financial services business. The first thing the company did was to opt for a multi-bank model for its UPI services. It's similar to what Google Pay and PhonePe have, where you can pay despite having any bank's account. In UPI business, Paytm is among the top 3 players, and so it earns money from the government as an incentive to facilitate UPI payments. Then there's the merchant payment business, where Paytm has doubled down in the last 1 year. It reached out to its merchant partners, improved the quality of their services, and also increased their merchant base significantly. Today, Paytm has around 4.5 crore merchants with it, and out of it, 1.3 crore have a subscription with the company. And in the last 1 year, this subscription number has increased by around 20 lakh, which is a very healthy growth. And because of all these steps, Paytm's revenue from its payment business has grown 28% in the most recent quarter, and now payments alone account for 54% of its total revenue. So it's safe to say now that Paytm has found its core business and the company is doubling down on it. Now, one thing you have to understand is that payments business is important for Paytm not just because of the revenue it brings, but it also allows the company to cross-sell other services. Services like merchant loans. In the most recent quarter, Paytm's revenue from financial services has almost doubled to 561 crore rupees. Also, 50% of merchants who took loans from Paytm were repeat borrowers, which shows high stickiness and product market fit. So the focus on its core business was the first thing Paytm did to turn around things. The next thing it did successfully is cost cutting and the use of AI. In the first quarter of FY26, Paytm's marketing expenses fell by over half. From 221 crore rupees last year, it has come down to 99.8 crore rupees in the same quarter this year. Then there is employee expense, which is reduced by 1/3, falling from 952.5 crore rupees to 643 crore rupees in the same quarter this year. And one reason Paytm could cut costs so aggressively is the use of AI. See, in the last 1 year, Paytm has laid off thousands of employees, and despite that, its revenue has increased and its operations have become more efficient. And the reason is heavy use of AI. Vijay Shekhar Sharma has himself said it recently that sooner or later we will have to start using AI as an employee or even as a CFO. But it looks like that Paytm is already doing it. According to this article of Economic Times, Paytm is using AI for merchant onboarding, fraud detection, segmentations, and price optimization. And because of all these efforts, Paytm has had a dream quarterly results recently. It posted its first ever net profit of 123 crore rupees, and also its revenue has increased 28% year on year. In terms of its stock price, it's the highest in almost last 3 years, and it seems like the company will see a sustainable growth from here. Let me know what you think of this turnaround journey of Paytm, and what's your biggest takeaway from this video. Let me know in the comments, and I'll see you in the next one.